Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Ehrman.
Hello, and welcome back to the podcast. Thank you very much for being here. I appreciate it. Today, we are going to do some more myths because you guys liked them. So I'm going to mix them. Myths about IBC and myths about life insurance, because IBC is not life insurance, right? IBC is the concept of what we're doing around these joints. And so let's talk about a couple more myths. This would actually be number 6. Because if you didn't listen to the last podcast, you're going to want to go listen to that podcast about myths. That's 1 through 5. And I have gotten some great feedback on that. That's why we're doing this again. And before I even start, I am going to send you to the Without the Bank podcast because I've been recording some stuff on there that I'm not recording over here. And so you're going to want to go to both. Someday, maybe I'll just join the two together. I don't know. It's just a lot of extra work. And why not? Why not? Okay. Number 6, whole life is bad because you don't get the cash value and the death benefit. This is so silly to me because if you actually understand what is going on with life insurance, you wouldn't even have this as an issue. However, our big talking heads have this as an issue, right? So let's explain what cash value is. Cash value is a part of the death benefit that you get to use while you're alive. Okay? There's more technical terms for that, but I'm going to break it down and make it somewhat simple. The cash value is a portion of the death benefit you get to use while you're alive. And so you can refer to it as a living benefit. That's what some people refer to it as. Why would you get your cash value and your death benefit when you die if it's a part of the death benefit you're using while you're alive? You don't get the equity in your home and the sale of your home. It just doesn't work that way, right? And so people misunderstand that. Number 7, IBC is a life insurance policy. Well, I started the podcast with this one. I didn't know that was on my list. IBC is not a life insurance policy. And I believe even I have said this in the past, and I'm trying to correct myself when we talk about, I want an IBC policy. IBC is the infinite banking concept. It is a thought process. The life insurance policy is a tool to that thought process. It is a tool to utilize our money correctly. IBC is not a life insurance policy. And so there's a lot of us going around talking about, I want my IBC policy. Do you have an IBC policy? It is a life insurance policy with a paid-up additions rider. That's what the policy is. It is not this grand thing that Nelson created. It had always been there. And so make sure that when you are using your language, that we are using that correctly. It is not an IBC policy. It is a policy with a paid-up additions rider, and we're utilizing it for IBC. That is where a lot of people get in trouble when they start trying to go to different agents who have no idea. I actually had a client yesterday that said, oh my gosh, there is so much to this that I can't believe, you're going to help us, right? You're going to help us through all of this stuff. Yes, absolutely. I'm going to help you through everything. Because there is a lot. He's like, there is so much to know and there are so many moving parts. And he wants to know, how do we take a loan? How do we pay it back? How do we amortize it? How does the insurance company treat the interest on the loan? That's like a whole animal in itself. And so we have to make sure that we're working with somebody that understands life insurance and the infinite banking concept because they go hand in hand, my friends. Okay. Number 8, IBC is about a rate of return. Oh my gosh, there are so many podcasts about this, but I'm just going to bring this up as a myth because so many people talk about, oh, what's your rate of return in the policy? If you are having somebody sell you a policy based on rate of return, it is most likely an IUL, an indexed universal life, a universal life, or a variable universal life. And none of those are good. None of them. And so it is not about a rate of return. If somebody is trying to sell you something based on a rate of return, and it's life insurance, those two things do not go together. So you should run, but why is it about a rate of return? Like this isn't, Nelson never talked about it. I don't talk about it in my book. It has got nothing to do with rate of return. I did, again, have a different client yesterday that was talking about rates of return, and he kept going back to rates of return, because he is so ingrained in thinking about the market. And I finally said, well, why don't you just borrow against your cash value and go invest in whatever the market is? You're going to get the market return and you're going to get your cash value piece. It is not about a rate of return. It is about guarantees and liquidity and control. If it's those three things that we are not offered in any other product. So it is not about a rate of return. That makes my head want to explode. And y'all know that, but I'm going to cover that as a myth. Number 9, you're overpaying for the cost of insurance, which is why you're getting a dividend. This again is the talking heads talking about what the dividend is. The dividend is a formula. You guys have heard me talk about that over and over and over. And that formula is based on how much premium you've paid, how much cash value you have, how much death benefit you have. It is categorized as a return of premium. Yes. And so after I heard that, I thought, well, I don't want to be wrong. So I went to the life insurance company and said, is it strictly a return of premium? And they said, no. If the company makes a profit, we are also sharing that profit. Now, if there's a profit because we expected more people to die than died, is that okay? Yes. Then we're going to return that. And so this special talking head, the dipstick, if he thinks that it is, I've overpaid for insurance, how are they supposed to know exactly how many people are going to die and exactly how many claims are going to get paid out? So what do they do if they overproject? What do they do if they underproject? Then they want more premium, and then that would be bad, and we would all be ticked off about that, right? Because that's exactly what's happening in universal life. Oh, we upped our fees, so now we're going to have to increase your premium. I mean, let's think about that. And so am I okay with paying a little bit more and getting that back because the company, no people didn't die? The number of people didn't die that the insurance company thought was going to die? Yeah, but did that mean I overpaid on my policy? No. That just means collectively they had more money because people didn't pass away and they didn't have to pay those claims. I suppose instead of giving a dividend, they could just hoard it like any other stock company. Come on, dipstick. Like that is the kind of stuff that people are not understanding. And they're thinking, oh, well, I overpaid. Okay, well, don't you think you're overpaying for your term insurance if it's a return of premium term insurance? Let's think about that. There's a lot of term insurance out there that is a return of premium. If you don't die within that term, you get the money back. What about that? It is managing that pool. And I am thrilled that they're managing the pool and that they are giving some of that back to you. Because what happens when the bank is making a whole bunch of money right now? Is the bank sharing bigger dividends? Is the bank sharing any of that profit? Because, they made too much and they've made a little bit more than they thought they would make. They did really well this year. So they're going to share that with us? No, that's not how that goes. So yes, there is a return of premium. That is how it is categorized. Thank God, because otherwise we'd have to pay taxes on the dividend. Number 10, there are fees in whole life. There are not fees in whole life. There is a cost of insurance charge. Every single policy has cost of insurance. That cost of insurance is pretty much going to be the same. Does not matter what type of policy you have. If you're going to die, the insurance company knows that they are going to have a cost of insurance, right? If you're planning to live longer and you're healthy, your cost of insurance might go down. If you are unhealthy and you are a tobacco user and you have sleep apnea and you're diabetic, your cost of insurance is going to be more expensive. So inside of whole life, there's cost of insurance. They're called load fees. Yes, there are those fees, but they're wrapped up into what your premium already is. So what happens is when you go to a financial advisor or a certain life insurance agent, they will say, especially a financial advisor, they'll go, oh my God, the fees in those policies are so expensive. Where are these expensive fees? Because they're not on the outside. They're all built into the premium already with whole life. They figured it out. They built it in. With universal life, there is no built-in. It's all externally. So you have to pay for your cost of insurance externally. You pay for your fees, your management fees, all these other fees. Those are all external fees that can go up and can go down. Inside of whole life, those fees are built in. They can't move. They already know what those costs are going to be. And there's no fee to say, oh, hey, we're managing in the market. We have to pay some market manager. There's no fee for those sort of things because whole life doesn't have anything in the market because we're not playing a market game here. So I love it when financial advisors, and I just had this 2 weeks ago, that a client was talking to a financial advisor and the financial advisor said, oh my gosh, that's so expensive. That's a terrible product, blah, 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 blah. A financial advisor that doesn't know his head from his behind. And that is because he was like, well, what are the fees? Okay, there aren't any fees. There are no fees to take a loan. If you take a loan, there is an interest charge. There are no fees to take a loan. There are no added fees on top of anything. And I just responded and said, well, if he is concerned about fees, what about his fees? Because if he's selling you an IRA or some sort of an annuity or something, there's fees. So what about his fees? Stupid. Anyway, a lot of people get hung up on that because they hear that. The word fees and cost of insurance isn't a topic with whole life because it's built in. Nothing can move like it does with universal life products. Universal life products that the cost of insurance can go up, the fees can go up, and they do all the time. So there's that. Okay, that is 6 through 10. I believe I have like 17 of these. So we will have a whole nother episode on myths. And as I keep seeing them, I'm going to keep adding them because these are shorter explanations and people seem to like that because then I don't ramble and I get straight to the point and I answer them. Anywho, okay, let me know if you have questions, comments, concerns. If you have a myth that you would like busted, email me, MaryJo at withoutthebank.com or go to themjhotline.com and leave me a message. All right, you guys, you have a fantastic rest of your day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.